But I can't tell you how often people have said things like, well, you know, interest rates today are not that high, because I remember in the 1980s when they went to, you know, 18%, that was really something. It's like, yes, but they only doubled in that cycle. This time they've gone from, you know, 0.25 or 0 to 5%. That's a 21-fold increase in a matter of less than 18 months. That is a completely different ballgame. And not only that, it's happened at a time when we had 0 interest rates for the preceding decade. So the amount of debt that was added in the 0 interest rate area, it's like training on flat ground only, and then someone puts you on a steep incline. Quite a different ballgame, right? That's the discipline of interest rates. So we have a whole generation of people that have no idea how to run on an incline because they were so used to money being free and flowing everywhere. And all of these really spurious concepts came out of the fact that money was priced at 0. So we had a world full of bubbles and nonsense and leverage and products and salesmanship with not a lot of meat on that bone. And that stuff is really starting to unravel now because of the rate discipline. So even if they start to cut rates, I would submit to you that the 0 interest rate time is behind us. At least for a considerable period of time to come. So again, nominal interest rates are not that high today. You go, wow, you know, they're around about the very long-term average. And you can see historically they're the very high peak, which was an anomaly in the 80s, in the late 70s, 80s. There was a bunch of factors that drove inflation at that time, not the least of which was demographics. Boomers, setting up house, all that, the spending on the Vietnam War was certainly in there, drove that. The response from Paul Volcker's Fed was to escalate interest rates, as we all know. And then when we look at this, we understand that that too was an anomaly, just like the 0 interest rate period we've come from was a very bizarre occurrence. So it's important to understand that even if they stay on hold at this point and don't hike rates further, real rates are quite high relative to where they were. So as inflation comes down and rates are still at 5%, if you get back to a inflation rate in the 2% range, and we're not that far from it. If you look at different statistics like Truflation and things that look under the hood, stripping out the housing component, which as we know in Canada has been boffo, crazy, again, driven by low interest rates and speculation. We take that out of the basket, inflation has definitely made some significant down moves. But the real rates being charged now are quite high. And that matters a lot because households, again, as I mentioned, we had a decade where no one understood the value of money. People didn't develop good habits. We didn't teach the young properly. The old were not leading the young well in many cases. Everybody was borrowing. And then we had a central bank telling people, don't worry, we won't be raising rates for years. That was the all clear to pile in. And did we ever in Canada? As you can see there, the debt payments, the household debt to service ratio is now just above 16% in Canada. Historically, that is much worse than the US was at the height of their credit bubble in the last cycle in 06-07, when Canada was kind of holier than thou. When the big crash happened in the housing market and the debt markets in the US, the Canadians were looking like they were really wise and disciplined, and everybody lauded our banking system, and Mark Carney got promotions, and it was awesome. Unfortunately, we don't learn a lot from easy sailing, it seems. And we took the wrong message from that episode. We took that we were somehow special, that debt here wasn't going to ever be a problem. In fact, it's come back to haunt us now. So again, I mentioned this in the panel. People think, well, we've already hiked rates and, you know, yes, Canada's had negative GDP quarters, 4 of the last 5. It's been on a per capita basis, we've had a very stagnant economy. Retail sales have been 4% year over year. We have 64% of Canadians say they're feeling worse off about their finances now than a year ago. We've had quite a degradation in the stability of households because of this increase in rates, but there's a lag. So it doesn't happen overnight, right? A lot of term debt, as we know, was taken out in the 2021 period when mortgage rates were less than 2%, as an example, and all types of credit were at 5,000-year lows in interest rates. So people, again, running on flat ground, thinking this is easy. And then as rates have been hiked over the last while, only variable rate mortgages have really felt that. And we know that the banks went to this craziness of letting people amortize and add to the term instead of paying the actual amount of interest that's accumulated. This is all a disaster. Did anyone hear of the subprime problem in the United States in 2006? Again, we took a page from the playbook and implemented it on a national scale.
Real quick break here, guys. If you are a mining investor, you are without question familiar with the Golden Triangle region in British Columbia. This is one of the most prolific mining regions in the world due to its vast deposits of gold, silver, and copper. Now, for the last 4 years, Dolly Varden Silver has been busy expanding their high-grade silver deposit in the Triangle, and they are backed by some of the smartest investors in the silver business, including the legendary Eric Sprott, Hecla Mining, US Global Investors, Fidelity, Delbrook Capital, Sprott Resource Corp, and more. If you are curious why the smartest money in the silver business is cozying up to Dolly Varden Silver, then hit the link beneath this video.
So right now there's this obsession around soft landings, saying how don't worry, it's all going to be well because, they've hiked rates and it hasn't blown up yet. I mean, under the hood, again, Canada's economy is really weak. We could be in a recession already. We won't actually know because they won't verify that until months from now in retrospect. But this preponderance of people insisting we've made it through the woods and all is well, this obsession with the soft landing narrative. Again, I've been around a few rodeos. I remember this stuff. I remember it in the 2000 cycle. I remember it in the 07 cycle when everyone said, no, nothing bad's going to happen. Well, we know exactly how that turned out. So again, about 70% of Canadian mortgages will reset at higher rates over the next 3 years. This is a US chart, but we have a similar situation in Canada. So we have this gross domestic product reading, of course, that we've all fixated as a barometer of how our economy is doing. But in fact, if someone's selling goods in the economy, the measurement of GDP should be replicated in the incomes that are collected by corporations, households. This balance is supposed to be pretty consistent, and you can see that chart goes back a long way and shows that there's this correlation typically between GDP and GDI, gross domestic income, and they are supposed to reflect one another. They're two sums of the equation, two ends of the same equation. And right now we've got this disconnect where GDI is actually contracting negative 0.2% in the latest reading, and gross domestic product, as we know, in the US came out recently just below 5%. Again, yay, we've made it through the storm, all is well. A little bit premature there when we look at the actual incomes that are being collected. So the money supply, this is the US cash-like deposits, same kind of thing in Canada. The amount of savings, we know cash-like deposits went up during the pandemic from all the infusions from governments, right? People got a lot of checks that helped them make ends meet, deferrals of payment, a lot of things on hold. The government, the corporate loans that were made during the pandemic in Canada have just come up now as being due. A lot of small businesses had $40,000 to $60,000 loans, and the deal was this is interest-free. You have to pay it back by the January of 24, and we'll forgive a portion of that. And if not, it starts accruing at 5% as a loan. That's happening now, and 40% of businesses are saying they can't possibly, there's no money. They can't pay it back. So another example of sometimes how free money and handouts may seem like a Band-Aid solution, but in the end, if it's a solvency issue, if it's a deficit of revenue, if it's an unproductivity problem, throwing money at it in little gifts doesn't really do anything in the longer run.